Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, January 31st, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Futures currently are down, although they are off their worst levels overnight. Currently, the Dow Jones futures down about 115 points. S&P 500 futures down about 7. NASDAQ futures down about 39. This comes on the heels of one of the worst days recently. We've had a really nice uptrend in January, had a down day on Monday, which we'll talk about in just a minute. But it does look like we are going to, at least in the morning, continue that weakness from yesterday. Crude oil prices down about 75 cents to around $77 a barrel. And the U.S. 10-year Treasury yield this morning down a little over 3 basis points. 3.52% remaining in that downtrend, but off of the recent lows, which we saw down around 3.37%. Before we get into anything today, I will take you over to earnings beats. Actually, before we get into that, let me walk you briefly through today's agenda. So we'll start off with the daily market recap, jump into talking technically. Take a look at a few industry groups just to see on an absolute price chart what some of the key groups have done in January, where we might look for support on a continuing pullback. Then we'll look at earnings spotlight. Earnings really picking up this week and especially next week. Got some big ones later this week, including Apple and Amazon and Alphabet, all on Thursday after the market closes. That certainly will be big for this week. And then we'll wrap up with 3 you must see. I'm going to look at a couple of stocks that have had pretty decent runs, but let's look at them on a weekly basis, because while the daily charts look much, much better, there is some things that we probably should be looking at on the weekly basis that may not be quite so good. All right, so let's move over to earnings beats. For those of you who are new, welcome. Certainly appreciate you joining the show. And for those who have been around and are loyal supporters, I want to thank you as well. If you go down Earnings Beats at our homepage, you will see an area to subscribe to our Earnings Beats Digest newsletter. It's a great way to get to know us and to maybe understand some of the things that we look at. I wouldn't expect that we would change your trading style, but maybe there are some things that you could pick up that might improve some of your trading or investing skills. It is a 3 times a week newsletter, Mondays, Wednesdays, Fridays. All it takes is a name and email address. Hit that subscribe button. You'll be good to go. No credit card required. You can unsubscribe at any time. Feel free. We know, we're not, everybody's got a different style. We may set up nicely for you. We may not, and that's fine. But I do think you'll find some of the tidbits that I provide on here educational. At least that's what I strive for. It's a very quick read. So if you're worried about, I got enough newsletters. I mean, this is literally 2 paragraphs in a chart. So you normally can get through it probably in a minute or 2. But anyway, check that out. Love to have you. Anyone who does subscribe is always invited to our free events, and we have plenty of those throughout the year. So make sure you start your free subscription there. Moving on to the action. So let's talk about what happened yesterday in our daily market recap here. Dow Jones Industrial Average down 261 points, S&P down 52, NASDAQ down 228, mid caps down 29, small caps down 13. There was nowhere to hide yesterday in equities. We had profit taking kick in, and everything was lower. Among the sectors, we had staples, the only group to finish in positive territory. And of course, they are a defensive group. So it wasn't a very bullish day, but after the run we've had, pullbacks are certainly inevitable. On the downside, or to the downside, energy was the big loser yesterday, dropping a little more than 2.25%. Back down almost right on its 20-day moving average. It was a few pennies but beneath it. Technology down 1.9%. Not able yet to get through the December high. Is this going to be a situation where maybe we just pull back to the rising 20-day? We'll probably find out. XLY down 1.7%, and communication services, which has been finally on a roll, We did see a breather yesterday with that group dropping about 1.6%. Let's move on. 10-year Treasury yield. Right now sitting at, well, yesterday's close, 3.55%. But as I mentioned just a couple minutes ago, pre-market, we are seeing the 10-year Treasury yield down a little bit more than 3 basis points, back down at 3.52%. So we closed right up at about the 20-day. At this point, it's starting to look like a little bit of sideways consolidation. We went through the moving averages, both of them, then right back down beneath them. Now we're threatening to move back up above. As I've said in recent shows, anytime I get what appears to be a double bottom or close to it, I always look at the high in between. So the double bottom marks your key support. Well, you're still in potentially a downtrend until you can break that high right there, which is up near 390. So I just see our range right now to maybe around 390, 391 to the upside. This low here was 340. This one was 337. So that gives you the range to the downside. At this point, based on what I'm seeing in other areas of the market, what I expect out of inflation, I suspect that the 10-year Treasury yield is going to go lower. But we have a Fed meeting. It starts today. We'll get the end of that Fed meeting tomorrow. We'll get the policy decision, what the Fed's going to do. Everyone's expecting one more hike, or at least one more hike. And then, but we do expect that the Fed is going to be talking about ending this cycle of rate hikes. So should the Fed come up with a big surprise, we saw one back in August, and that was right in here, and one actually was right about here. But the 10-year Treasury yield after that, you can see for the next 2 months went up, and the stock market had a lot of problems. So is the Fed going to drop a similar bomb? And might the 10-year Treasury yield move up? I mean, it's certainly a possibility. That's one possibility. I don't think that's the probability, but it is certainly a possibility. I don't know. I'm not a big fan of this Fed, as many of you probably know, just because I don't think that the transparency is the same as it's been under prior Fed chiefs, Yellen, and especially Bernanke. So we'll see what happens here. If you are new, my biggest problem with Powell was when they came out a few months ago and said that they need to see some evidence that inflation was slowing. And then, of course, we had a CPI report, core CPI report, that had dropped significantly. And then he came back and said, well, no, actually what we want to see is a series. We don't, we got to have a few of these reports before we're going to, let up. And so we had multiple reports come out that certainly were less inflationary. And then the word from the Fed was, well, we need to see a more definitive move back toward our 2 to 3% target. And so it's kind of just been this evolving thing that they're looking for. And I think that's what's thrown off the bond market and the stock market, because they really don't know what to expect from the Fed. The Fed says one thing, and then it happens, and then they kind of change their tune a little bit. So what are they going to say today? I don't think it has anything to do with whether they hike rates. I think everybody's looking for a rate hike today. I think the question is, what do they say? What do they see? What's the likelihood going forward? Are they going to talk about, hey, this is working and we're seeing signs that inflation is coming back down? I think the market obviously would love that. Or are they going to say, hey, inflation appears to be stubborn. We've been cutting rates. It hasn't really done much yet. And I think if the market walks away from this thinking, hey, this Fed is still not seeing the same thing everybody else is seeing, then we could see further selling. I think that's going to be a big theme. And listen, you don't have to agree with me. You can say, because I know there are some out there who think that the Fed's been pretty much just hawkish throughout. And I'm not going to say they haven't been hawkish throughout. I just feel like they've kind of changed their tune along the way, which is not exactly the transparency that Bernanke talked about many years ago. And so I just think this Fed is a little bit, I think they're maybe a little bit in a box, because they don't want to give up on inflation too soon. I get that. I understand that. But if the economy starts slowing and you keep raising rates, you are going to begin to increase the threats of deflation. And I still, a lot of people kind of moved on from inflation. Now you're hearing a lot more about recession. The thing that really would be bad for the stock market, it's not a recession. I think the market's already priced that in. It's not inflation. Market price that. I think the inflation deal's over. To me, the biggest risk is deflation. I've said that all along. And I think the Fed could go too far. And that's my bigger concern. It's not that they're hiking rates now. It's like if they keep talking tough about inflation and they keep this rate hike cycle going to the upside, the talk is going to be about deflation. And if you need an example of what deflation can do to a market, all you got to do is go back to the 80s and 90s in Japan and take a look at the multiple decades of pain and destruction that was done in that stock market. It 1970s in the US pales in comparison. I mean, inflation's not good, but deflation is the devil. So just be careful here with, the Fed, I just think needs to be a little careful. You don't want to start seeing a lot of inventories building. The earnings report that we just got from Intel last week, one of their big problems was inventory. You do not want companies building inventories because remember, when it was stay at home, everybody kind of shut down, supplies, inventories came down because nobody was manufacturing anything. And then once, we opened the doors, everybody wanted to get out and do things and buy things and go to restaurants and take trips when they could. And as a result, demand took back off again, way ahead of supply. And so we've been trying to catch up. And the fear for me is that all of a sudden demand falls off the table because of a really tough recession. And that in turn could lead to spiraling prices to the downside. That to me is the biggest concern. Not enough talk about it right now, to be honest. But that's what you need to look at. If I was bearish, that would be my bearish claim or my bearish thoughts, is that it would be deflation, not inflation, not recession. Restaurants right now and some of the other areas of consumer discretionary, travel and tourism, gambling, these things are going up. That if the market hadn't already priced in a recession, what would those stocks be going up for? I mean, some of forecasting the stock market really is just about common sense. Anyway, we'll see what happens. Let's keep moving here. S&P 500. So I don't really need to point out the key area of resistance. We went right up to 4,100, close to it, on Friday of last week and could not get through. There's the top in December, two tops. There's one the second week of September that was a reaction high off of that Jackson Hole speech where we saw a lot of distribution, a lot of selling. That was not a good period for the market. Here was the reaction high right before we had the next period of distribution right into the end of September. But with that poor September CPI report right here in this gap down, everything kind of changed and we've been moving up. Manipulation's been at its finest. We've seen some gap downs, but we've seen rallies off of them. I think the market since that October low looks really good. The Fed and inflation reports, though, have been the two keys that have been able to knock the market back down. And of course, again, we have a Fed meeting today and tomorrow. So it'll be interesting. I think we're going to see a lot of volatility at 2 p.m. tomorrow into the close. Up until then, usually I see the market move towards some key levels right before the announcement. And so as I look maybe on an hourly chart, I mean, here's the 50-hour moving average. This is pretty much like a trend line that we're on right now. Maybe we just stay in a pretty tight range between now and tomorrow at 2. If you're looking further, like if we break below the 50, then I would go maybe to the daily chart, and I'd be looking at that rising 20-day. I mean, that's down at 39.71. So we're still talking about another, 45, 46 points to get down to that level. That's only 1%. maybe that's where we're headed. Maybe it's the 20-day moving average that we'll have to figure out and then see what happens intraday. But there have been some wild swings after 2 o'clock. And I don't know if you noticed, but yesterday the volatility index picked up. I mean, we had some selling, so it kind of made sense, but it gapped up right off the bat. And I think it's probably market makers beginning to price in higher options, the premium on some of the near-term options. And the reason is because you have a high volatility event coming up. So when that happens, we could see clearly big moves in either direction. And I think the S&P could see that as well. And market makers are likely pricing that in. That's my take on the jump in the VIX yesterday. I wouldn't be surprised to see the VIX up again. Between now and tomorrow, I think the VIX could be up to 21, 22 easily. Just again, to price in those higher premiums on options, because I think you're going to get a lot of traders and investors, well, mostly traders, that are interested in trying to capture gains on these short-term swings. For me, I tend to try and sit it out, because while the volatility does present some nice upside, if you get it wrong, it also presents some ugly downside. And protecting capital is always my number one in terms of trading. If I'm talking about goals, I mean, I want to outperform the S&P 500. But during volatile periods, like what we saw in 2022, I want to protect capital. Number one. NASDAQ 100, similar. We did make that move and close slightly above the December high on Friday. Could not hold it, though. That is not what I would call a definitive breakout. If you look at a 5-day chart, 5-day, 10-minute chart, we had a pretty clear breakout on the NASDAQ 100. And then in the last 30 minutes, we sold off to come back down very close to the breakout level. We did finish slightly above it, but going up 100 points into the close, I think would have been much stronger technically than going down 100 points or 75 points or whatever it was into the close. So I think that kind of set the stage. We got a little selling yesterday and we've been moving lower. Again, futures today down a little bit. They have come back up off of the earlier lows that I talked about. Dow futures right now down about 50, S&P down 4, NASDAQ down 32. But by the time you get this, this recording will be into the trading day. So we'll see how the market's moving. For one thing I'd look for is maybe yesterday's high. If this is starting a downtrend, if you're up this morning at some point, you get back up above 12,000, 12,050 on the NASDAQ 100. See if we can get above 12,100. 12,100 would put in a higher high above yesterday's high. I think that would be, at least in the short term, a significant move. But to the downside, we've basically finished on the low. So if we do open lower this morning, which it appears we may, we could have a little bit further down move, at least in the near term. Let's see what the Fed says, and then let's go from there. I think the key through all of this for me will be the rising 20-day moving averages. Do we close back below that? Because we have been in a period of back and forth. This is a trendless market right here. When you go up above moving averages and back down below, above, down below, above, if we were to come back down below, it's giving us the look of a trendless market. Now, what I've talked about in the very short term here in January is that when you've got a rising PPO that moves above the center line, and you've got price action moving above your 20-day, and the 20-day crosses the 50-day, and your pullbacks hold the 20-day, that's the look of an uptrend. So in the very near term, we're uptrending. If we fall below the 20, I think that brings that uptrend into question. And potentially for the bears that are out there, could lead to another move back down to recent lows. The bulls, what they want to see is continuing to hold the 20-day, and let's break back out above 12,250. That's the two scenarios that I see in the short term. And which one plays out? We're going to find out this week. A lot going on this week between the key economic reports. You've got a jobs report coming out on Friday. The ADP report will be out tomorrow morning. Again, we've got the Fed. You've got got a lot of earnings reports coming out this week, but 3 major ones that folks, these are companies that can definitely move the market. We've got Apple, we've got Amazon, and we've got Alphabet all reporting Thursday after the close, with the Friday jobs report coming before the open. The market is going to have a lot of information to digest over the next few days. And where we finish technically through all of this, I think is important in the near term. All right, moving on to industries. Just want to talk very, very briefly about some of the industry groups, a couple of the key industry groups. So here's your semiconductors moving up, but pulling back here the last 2 days. It looked like we had a little bit of a breakout. Notice we were continuing to hold that rising 20-day. We need to hold that and break back out again for the semiconductors. And this is one of the bigger areas in the market. So let's kind of keep that in mind here. Another area we talked about, communication services. Big area in there is internet. Internet loves the month of January, and it's done it again. If I go over here, we'll come right back to this. But if we pull up seasonality on the internet stocks, I mean, you can see just in the last 5 years, averaging 4.7. But we could take this all the way back to the last 20 years, which is okay, not really great. But how about just for this bull market, which started in 2013? What's been leading? Right here, internet stocks up an average of 4.4% during the month of January over the last decade, 11 years. And so if we look at it relative to the S&P 500 and go back those same 11 years, internet is outperformed the S&P 500 now in 10 of the last 11 years, and averaged outperforming by 3.8%, which outside of July, or even including July, but July is the only other month that's even close to January. So this is a strong month, but what's going to happen in February? We end January today. Do internet stocks continue this uptrend, or are we just going to continue this downtrend, roll back over again? This is going to be a key group that I'm going to be watching. Another key group that I'm going to be watching is home builders. Are rates really coming down? A lot of folks think, rates are going to keep going up. Well, home builders completely disagree with you. Home construction stocks have been going up on an absolute basis solidly for the last 3 months. And they've been going up on a relative basis since, I believe, last April or March. Let's see. So let's show a relative strength chart here. All right, so there's your absolute move. But look at the relative move. All the way since over here, when we saw the index continuing to go lower, home builders kept going lower, but they weren't going down as fast as the S&P 500, so they started to show relative strength. And that relative strength now has been going on for about 9 months, almost 10 months. Does this make sense if rates are going to keep going up? No. Right now, home construction is reacting to the 10-year treasury yield, which has been coming down. Here's a barometer of what's going on in the mortgage with mortgage rates. 10-year treasury yield is what you can watch as far as what is likely taking place in the mortgage rate area. And that's been coming down for the last 3 months. So probably shouldn't find it too surprising that home builders have been going up. But they've been outperforming the S&P now for almost 10 months. Does that make sense if you believe inflation's a problem and that rates are going to keep going up? No. This is, again, the stock market pricing things in ahead of time. The absolute price breakout's just been, last 3 months. But this has been a key relative move now for almost 10 months. All right, let's talk a little bit about earnings before we wrap up with the 3 must-see. Just a few earnings reports that I wanted to go over. So first, you got the XOM, which is ExxonMobil. They reported this morning. Let's get a quick update here because that was earlier when I was looking. And it's down, but really fractionally. It's been a pretty strong performer. Maybe watch that 20-day moving average just a little bit below 112.50. That'll be an interesting area on the stock today. PFE, which is Pfizer, down 3% this morning after reporting. McDonald's back down near key support level. It's down 265, but you can see this 260, 265 area. Ignore this big long tail, by the way. That was last Tuesday. Remember, we had the glitch. There were some stocks that, prices just went every which way. In the morning, that was not a true, the stock never went down below probably 268 that day. But anyway, watch this 260, 265 area. That's where I would expect McDonald's to turn and begin to move higher. UPS, pretty good day. Reaction up almost $5, 2.6%, but still within its trading range. And Caterpillar, which reported down $6, down 2%. And that's back down close to that rising 20-day where it's been finding support. So I'll be looking to see if it can hold that support today. All right, let's talk a little bit about the 3 you must see. So I thought what I would do on the 3 you must see today is look at the weekly charts. Because here's Tesla, and I could go to a daily chart. And if I pull up the relative chart here, it's broken above the 20, it's broken above the 50. All of a sudden, the AD line is taking off again. Big volume trends. We've started to turn back up again versus the autos. Looking at the daily chart, things have looked a lot, certainly look a lot better. But I think we need to look at the weekly chart because there are a couple things that have happened here with Tesla recently. Number one is we had a topping head and shoulder pattern, which if we go in here and, probably right about in there, actually, if we did candle bodies, maybe it's like that. But the point is right in here is where we broke down. And normally in a downtrend, when you are, broken down like Tesla was on the weekly chart, normally when you come back up and hit the 20-period moving average, or in this case, the 20-week moving average, that tends to be the area where you find resistance and you roll back over. And so with that, now look, 180 was kind of the area that we should be watching for. That's the 20-week moving average, 180. And if we look at the daily chart, that's right where we got to, 180, before we lost $11 yesterday. So I think Tesla has clearly marked an important low now, and this may turn out to be an important high in the short term. Let's see if we can make this breakout. A couple of others I wanted to go over. Let's look at these on a weekly basis as well. Salesforce.com. So it's been on fire in January, but if you notice, as we were going down, lower prices, higher PPO, positive divergence, which normally leads to a 50-period test. That's right where Salesforce.com is. So this is another one that I think's got its work cut out for it in the short term. The last one I wanted to give you is O'Reilly. O'Reilly actually looks much better to me. Don't technically have a negative divergence because the PPO rolled over, but price action never went higher. But we got this double top breakout here around 750, maybe even 740. Looks like we're heading back down to that level potentially. I actually like this one. This one looks much better to me. So if we do see continuing selling, I think that 750 area would be very interesting on O'Reilly. All right, that's it for me. Appreciate everybody tuning in. Everybody have a great day. Happy trading. Let's see what happens. We got a lot going on this week. How does the market come out of this? That's going to be a big question. Join me tomorrow over at earningsbeats.com for your next Trading Places Live. Simply go over to Earnings Beats anytime after about 8:45. Click on this late Trading Places Live link. Right now, we have the recording from yesterday, but tomorrow, if you come in after 8:45, there will be a listen live link. Just click on it. It's free. Come on in. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.